Welcome everybody. Thank you for joining me today. So we're going to be talking about mortgage. Given today's market, it's a difficult conversation right now with regards to rates, and hopefully I'll give you guys some insight into some things that are helping us and helping buyers. And along the way, if you feel like you have any questions, please feel free to raise your hand or put something into the chat. And I think Elsie can forward that over to me, and we'll address any questions that you guys have along the way. So hopefully you guys can see my screen okay. So we'll just jump right into it. So I will give you a little bit of background on myself. Having a little bit, okay, there we go. Bear with me if I have technical difficulties, but my name's Ignacio, and I graduated from USC in 2002 and actually got a degree in real estate finance, business with an emphasis in real estate finance. So usually, it's kind of rare that people major in, what they are currently practicing. So I actually got a degree in what I'm doing today. I was licensed as a real estate broker starting in 2004. And have done some real estate. So I do kind of know what you guys go through on a day-to-day. So I've got that background as well. I started in the industry actually doing notary signings as a notary public. So I started doing loan doc signings, began processing loans, and then, like I said, did some residential real estate in the early 2000s, and then transitioned into becoming a loan officer, where I went to work for William Lyon Homes, where I was at for about 15 years. So I was there at the home builder, basically focusing only on purchases. So I'm very familiar with the purchase transaction, what is involved from start to finish. And, in new home sales, those escrows can last anywhere from 30 to, 360 days. So you're, holding the buyer's hand throughout the entire process. And so I'm very familiar with, what it takes to get a deal closed. After being at the builder for 15 years, in 2019, I broke away with my business partner, Jason, who's normally on the call, but he's in Colorado with his family, enjoying some family time. So it'll just be me on the call today. And we started the brokerage, and we've now got about 13 people on the team. We're licensed in 6 different states, and yeah, we've closed, we just had our 4-year anniversary and closed about 500 million in volume so far, which is a pretty big number. So we're really happy to have helped a lot of people along the way and created great relationships. So I currently live in Irvine, and yeah, so that's a little background on myself. So today, here's some of the stuff we're going to talk about. We'll look a little bit at current market conditions. What are rates doing? What does the real estate market overall look like? We'll go over some of the benefits of homeownership. Most of you probably already know, but just kind of do a refresher on why it's still a benefit to buy and buy now, even given this difficult market that we're in. We'll look at the pre-approval process. What is it? What does it entail? What does it look like on the buyer side? We'll look at some common mistakes that people make in the mortgage process and how to avoid some of that stuff. We'll do a quick overview on what's the credit score, what is it made out of, what comprises your credit score, and how can you improve it, and what are some things to avoid. We'll kind of go over a process overview on the lending process from start to finish. We'll look at the different lending sources and kind of some of the differences between the different sources that are out there in today's market. We'll look at some of the programs that are available in today's market, and just kind of talk about what you guys should look for in the right mortgage partner and why it's important. Okay. All right. So, and please feel free to comment, ask questions along the way if you guys have any input whatsoever. So kind of the biggest discussion today is the rates, right? So right now, and I'll just kind of skip forward into the next slide. So you can see here that today, And this is off of Freddie Mac's website. Any of you can go on to FreddieMac.com. If you just type in Freddie Mac rates, I think the first or second link on Google will take you right to this page, and you can customize the bottom and move the time frame and look at, you know, the last 12 months, or, you know, span it out to the last 50 years on what rates have done. But you can see this is as of today, or I'm sorry, as of last Thursday, the weekly average. We're almost at 7% on a 30-year mortgage. And if you look at the graph, the last time that we saw those rates was 22 years ago, back in 2001. We were around the 7% mark. So the fact that we're, you know, seeing the rates and 22-year highs is pretty significant. You know, obviously that's why people are talking about it. We're also seeing, you know, prices at an all-time high. And so when you've got those two things combined, obviously it's really affecting affordability. So that's the main objection that we're hearing, you know, in today's market. Now, if you were to pull this chart way back, you know, to like the 70s, 80s, obviously you would know that rates have been, you know, in the high teens. So when you put that into perspective and look at overall where rates have been historically, you know, you do make an argument for the fact that it is still a good time to buy. That obviously combined with the fact that you still have appreciation. I think where the Case-Shiller is up to, I think almost 5% year to date. So, you know, the fact that you still have appreciation despite the high interest rates is a testament to that, you know, the fact that it's still a good investment to purchase real estate today. It's still a good way to create generational wealth. So let's go back to the market conditions. So in a future slide, we'll look at the actual impact to affordability and look at like a real world scenario on how the rates and the prices have affected affordability. Given those rates, we are seeing ARMs making a comeback, so adjustable rate mortgages. Let me see if I've got a question here. Oh, it's just Elsie. Yeah, if you have any questions, feel free to put them in the chat. So ARMs are becoming more popular. So as the rates, you know, have gone up, we've seen people moving from a fixed rate mortgage to ARMs, which typically carry a lower interest rate, especially in the jumbo market. So, you know, when you've got a larger loan amount, the ARM, some cases being 0.5 to a full % lower than the fixed, you know, that difference in rate can make a big difference in your payment, especially if you're looking at loan amounts over $1 million, okay? What we're seeing in the market, we are still in a very strong seller's market. We are still seeing multiple offers on almost every property that we're working with buyers on. One of the things that happened during COVID, you know, when people refinanced into a 2 and 3% interest rate, those people, they really have no intention of selling. We did a survey with all of our past clients, and only 20% of homeowners right now are even considering selling. The other 80% said that because they have a rate below 3%, they're not even considering selling or moving into a different home. So 80% of the people that refinanced with the low rate have no intention of selling. So that's taken a lot of supply off of the market. And that's one of the reasons why we're still seeing multiple offers and bidding wars and pricing appreciate, is because there's just no supply. So the basic law of supply and demand says that if there's little supply, you know, even if there's normal demand, that's going to raise prices up because the demand is higher than the supply of homes that are available, okay? Because of the high rates, we're still seeing sellers offering credits. So buyers are putting in offers and asking for rate buy downs, and sellers understand that in order to make the deal work, they're having to give concessions to do buy downs. And that can be in the form of a temporary buy down or a permanent buy down. And we'll actually look at a temporary buy down scenario so we can understand it, and I can walk you through how to calculate the cost. And that's, I think, one of the more successful programs that we are using today in order to help affordability, and in some cases to help, ease that high rate situation and get a buyer to feel comfortable with the payment. Okay. So I guess in conclusion, we got to be prepared to serve the client. So someone's asking what the buy down is. So yeah, we'll get a little bit more into that and we'll explain it. And we'll look at an actual Excel spreadsheet and kind of what the cost is and how it helps the buyer. And I'll explain all that to you. So yeah, we just got to be prepared to serve the client, especially in this market where we've got really high rates, volume is down for everybody. You want to be as prepared as possible with the programs that are going to help the buyer with their specific situation. And just always be ready for change, right? So, I mean, during COVID and the year after, the market was absolutely on fire. There was plenty of refinances to go around. Everyone was buying, but then we had a very fast change, right? We shifted from that to a very quick increase in rates, and that really slowed everything down. And so as we go through these transitions, we're going to see another change, right? So the Fed has been ratcheting up the short-term rates in an effort to try to slow the economy down, and I think, in my opinion, to try to force unemployment, to try to get inflation under control. We have seen inflation come down. It's come down from 9% to like just under 5%, but that really hasn't translated into lower interest rates yet. And I think part of that is because of the narrative that the Fed has, that they're going to continue to raise rates because they haven't really seen the changes to the economy that they're waiting for. And so I think it's possible that the Fed might raise rates 1 or maybe 2 more times this year. And hopefully as that continues to affect inflation and bring it down, you will eventually see rates come down. And if you look at the chart here, the historical chart, these shaded areas are actually recessions. So you can see that, during the recession or immediately following the recession, the rates are always coming down, right? They're trending downward. So obviously right now where we are, we're at the peak of the rates. And actually it looks like on this chart, you can see that they're actually still going up. But as the economy, or as the Fed tries to force the economy to slow down and we go into a recession, you should see those rates come down. And most of the time, or historically, in a recession, the real estate market always appreciates. The only time that did not happen was in the big crash of 08, 09. And as you all know, there were some different things involved in that recession. It had to do a lot with the types of loans that we were giving out. And it was a very specific situation. But in all other recessions, if you look historically, the real estate market has appreciated. So combine that with the low supply that we talked about earlier, I think we're setting up for that scenario again, where if the economy slows and rates go down, I think we'll continue to see appreciation go up. Okay, so this is that example that I was talking about. This is a real world example that we closed a loan on. So you can see in the first column, this was a scenario in December of 2021. It was $1 million purchase price. The person put down about $350,000. The interest rate was 2.92%. The principal and interest payment was $2,700. And you can see this was their income. Their monthly liabilities was $532. I think they had a car loan and a couple credit cards. And their total housing payment with taxes, insurance, and everything was $3,846 a month. Their debt to income ratio was 37%. Okay. Now this was from a previous class that we taught in October. You can see the rate has now gone up to almost 7%. So it's more than doubled. principal and interest payment has gone up to $4,200, and their debts are still the same. Their income is the same, but you can see that their total housing payment went up to the point where it put their debt to income ratio at 51%. So this same exact buyer, had they waited until October of the following year, they actually would not have qualified for the same purchase price, but using the current rates. So you can see the real world impact of rates on affordability. So if you look down in the bottom, the difference in monthly payment was over $1,500 a month. The rate differential was almost 4%, so 3.87% increase from the closing in December to October of 22. So less than a year, the rate went up almost 4%, which is a 232% increase. And the very bottom, you can see that using the same income, but with the higher interest rate, this same buyer would only qualify for a loan amount of $414,000 instead of the $647 that they did qualify for. So that's a $232,000 decrease in the buyer's buying power. Okay, so again, just trying to illustrate what the effect of the increase in rates is on affordability. So it's a real world issue that people are having to grasp as they're considering whether it's a good time to buy or not. So I just wanted to show you this actual example of real closings that we worked with. Any questions on that? Okay. So somebody in the chat asked, why does real estate appreciate during a recession? And it has mostly to do with the rates, right? So as the Fed is increasing the rates to try to slow the economy down, what that will eventually do is bring down inflation. Unfortunately, business typically will suffer, and that'll cause them to lower prices, which will bring inflation down faster. And then the rates typically follow inflation. So as inflation comes down and the rates come down, the lower rates spur lending activity, right? Then the idea is, now that we're in a recession, the rates come down. Now they're trying to spur activity to bring the economy out of a recession. And as the rates improve, that typically motivates people to purchase. And obviously when people purchase and there's more demand, then that tends to have housing appreciate, okay? And now combined with the fact that we have very low supply, like we talked about, if you look at a supply and demand graph, right? As the supply goes down and demand increases, that typically will force the price up, because when there's a scarce product and there's multiple people that want it, that makes it more valuable. And so that will drive the price up as well. Somebody asked what's included in the calculation of total income. So when you are qualifying a buyer for a loan, you're looking at the gross income before tax deductions. So if you work at a salaried position and you make $10,000 a month gross before tax, that's the income that we will use to qualify you. And then on the debt side, you will use the total housing payment. So that's the mortgage payment, which is principal and interest, the taxes, property taxes, homeowners insurance, mortgage insurance if they have less than 20% down, and HOA dues if the home is in an association. And then you also include in their monthly debts like car payments, school loans, credit cards, and that's what makes up the total debt to income ratio, okay? All right, so looks like we'll just quickly touch on the benefits. I assume you all know, but homeownership is still one of the, the best ways to generate wealth, security, all that kind of stuff. So one of the main things is monthly mortgage payments are fixed, right? So as you saw during COVID, rents were increasing at a record pace as well. If you own a home and you're in a 30-year fixed mortgage, which most people are, I think probably 95% of people that purchase homes are in a fixed mortgage, that mortgage payment doesn't change, right? So as the value of your home increases, your payment stays constant. And so the idea is that as you get older and your income, throughout your career increases, your payments are staying steady, which you can't typically say about rent. Rent is typically increasing. And so that's one of the main benefits, and usually one of the main drivers of people wanting to buy a home, because they're tired of paying rent that's increasing every year, right? Another reason is the tax benefits, right? So you've got mortgage interest that you can write off against your taxable income, as well as property tax deductions. So a lot of times, when people purchase a home, it allows them to get tax benefits. So that's another big reason. You can always refinance your mortgage. So right now, what we're telling people that are buying is that you're going to most likely refinance your loan in the next 12 to 18 months. So we're telling people that it's still a good idea to buy, even though we're seeing record high rates in the last 22 years, as we mentioned. But as the Fed continues to raise rates and inflation goes down, rates will eventually drop. And so what you're doing is, because home prices are going up, you're buying now, you're getting into the market, and then prices will continue to appreciate. But when rates drop, you can refinance. You've already gotten into the home and started building equity, but now you can bring your payment down to a more affordable level. So that's one of the great benefits of being able to buy, is you can always refinance if rates drop. Home price appreciation, we mentioned. You can renovate and personalize your home. You can do that in a rental, but the landlord may not allow it, and you also may be throwing money away, right? Because when you leave, you're not going to get any of that value back. That's going to pass on to the homeowner and to the next tenant. You always have the ability to access your equity. So right now, we're historically at the highest amounts of equity that we've seen because we're at record home price levels. And if you own your home, you can access that through refinance, by a cash out refinance, or by doing a home equity line. So a home equity line is kind of like a credit card, but it's on your home, and you can access that equity that you have through writing a check or an actual credit card that you can use that's tied to your home. So that's one of the great benefits of owning a home, is that you can use that to, purchase a new property, to finance your kids' college, take a vacation, anything that you want, you can use that equity for. Acquiring rental properties for passive income. So that's another benefit of owning property, is that you can generate income from it. And if you do it the right way, it's passive income. So you're not really involved, but you're still collecting a check every month. So it's a good way to plan your retirement. Other tax benefits you can accomplish by doing a 1031 exchange. So if you have a rental property, you can sell that property and transfer the proceeds into a new purchase within a certain amount of time, and you can defer paying any taxes on those proceeds. And then just the pride of ownership, right? So the American dream is still, home ownership, and people still take a lot of pride in that. I know I do. And yeah, so these are the main benefits that we kind of saw as reasons to help reinforce your buyers why it's still a good reason and still a good time to buy. So I've got a question here about a 1031 exchange, if it's only for investment properties. And the answer is yes. A 1031 is like for like. So if you own an investment property and you want to defer the capital gains tax on that sale, you have to identify the replacement property within 45 days, and you have to close escrow on it within 6 months in order to qualify for a 1031 exchange. And it is for investment only. So you cannot sell an investment property and then use that for a 1031 to buy a primary residence. that would not qualify. It has to be investment for investment. Okay. So hopefully that answers your question. Okay, let's talk a little bit about the pre-approval process. So it's really important to get your buyers pre-approved. It's, you know, obviously no one wants to be wasting their time. So, you know, you don't want to be going out and showing property to a buyer that you know is not pre-approved, because, you know, the pre-approval process is going to help uncover any issues or challenges that they might have with being able to qualify for the loan itself. And so you kind of want to go through that process before you start showing property, to have a good sense of, you know, what their qualifying and buying power is, right? So that's kind of what the pre-approval process is. And it just starts with an overall conversation with the buyer. We'll talk to them and just try to get a sense for exactly what they're trying to do. You know, whether they're trying to buy an investment property, or this is a primary residence for their family, and maybe if they already own another property, what they're going to do with that. Are they going to sell it? Are they going to try to rent it out? So we want to try to understand the overall picture of what's going on, so that we can best help your client. Once we kind of have that overall understanding, we go on to the next step, which is getting the actual loan application. This is where we're going to get information on their employment history. You know, what do they have in the bank? What kind of assets do they have? Where's their down payment coming from? What's their income? Are they self-employed? And we're going to go over the different loan programs that are available to them based on the down payment that they have, based on the income. Do they qualify for maybe a first-time buyer program? We'll talk about rates and payments and kind of make sure that it fits into what their goal is and what their financial plan looks like. This is also where we're going to talk about things like their debt to income ratio, whether there's reserve requirements on the program that they want or qualify for, and answer any questions that they have based on, you know, where the conversation is going. We'll run AUS. So AUS stands for Automated Underwriting System. This is done through Fannie Mae or Freddie Mac. And this is to make sure that we're not missing anything. So AUS will run their credit report through the system. It'll pick up on any foreclosures, bankruptcies, things like that. If we've missed something, you know, through the visible scan of all their information. So this is a tool to help us make sure that we're being thorough, but also it's, you know, it's important on files where the debt to income ratio is very tight, or there's other issues. The system will tell us if Fannie or Freddie is going to accept this loan. So it's just another layer to know whether that buyer is approved. And, you know, we run AUS on every single file, and it's really important to know that your loan officer has done that to make sure that it's not picking up anything that you might have missed. Once we go through that process, we're going to ask the buyer to provide documentation to validate all the information that they put on the application. So we're going to ask for pay stubs, W-2s, tax returns. We're going to ask for bank statements and potentially even 401k accounts if we need more reserves. And so this is important because this allows us to confirm everything that they've put on the application, right? And a lot of times things do differ. Like people will put that they make X amount per month, but in reality they're paid hourly, and so we have to take an average of their income. So that might cut the income down. So it's important to look at the actual income documentation when we're calculating the income to make sure that we're using all of the income that the underwriter is going to allow for, not just what the buyer thinks that they bring home on a monthly basis. Because what the buyer thinks they make and what we can use to actually qualify for a buyer are two different things usually. And so that might affect what price we can qualify the buyer for. Now, one distinction is, So there's a pre-qualification, which is typically just us looking at the application and determining, if the buyer can qualify based on what's on the application. And then there's a pre-approval, which is us looking at the documentation, collecting it, and actually sending the file through underwriting. So this is what's called the TBD pre-approval. And it's actually having an underwriting approval without us just kind of guessing and using our experience. We're having an actual lender take a look at the file. And the reason why that's beneficial is because we're taking the guesswork out of wondering if they're going to qualify or hoping that our income calculation is accurate. And in this market where we're still competing against multiple offers, this is a good option because it can allow you to waive the loan approval contingency on your offer. So if you're submitting an offer and it's going up against an offer that still has loan approval contingency, but you've already removed yours, that's going to help your offer stand out against the rest. And so it does take a little bit more effort up front, but I can tell you that the buyers that go through this process have a lot more confidence in what they're shopping for. And they know that when they get their offer accepted, they're not stressing because they've essentially already gone through the underwriting process. The only thing that we're missing is an address. And so once they have an accepted offer, we send in the purchase agreement, and now they're just attaching that address to the buyer's already existing approval. So a lot of agents are not aware that this is an option. And so just know that it's out there. We can submit a file for a complete underwriting approval before you even have a property secured. So that's a TBD approval. And I think the next slide might talk a little bit about that. Yeah, so this just kind of points out, again, some of the reasons why we do the pre-approval. So we know what your buyer's purchasing power is. We know what the payments are, what they feel comfortable with, because, a buyer's idea of what price they might qualify for might be different once they know what the payment associated with that price is. You may feel like you can qualify for $1 million house, but once you know what the actual payment is, even if you can qualify for $1 million house, you might decide to only shop up to 800 or 900,000 because the payment at that price is more comfortable than the $1 million price. So a lot of times people do qualify for more, but they end up buying at a lower price point because they're more comfortable with the monthly payment. So bullet point number 2, again, the realtor is not wasting their time, and you're not wasting your buyer's time because you might be showing them homes that they don't qualify for. And so the pre-approval process will really help to get that detail out in the open so that everybody is on the same page. The loan officer can uncover any potential problems. So this is really important because a lot of times in the pre-approval process, we find out that maybe there's a challenge with documenting the down payment. Some buyers like to have mattress money and they don't put it in the bank. Well, that's a problem because the lenders do not accept any cash deposits. So we need to make sure that there is documentation sourcing where all the down payment money is coming from. Or maybe they don't have enough trade lines. They might have a great credit score, but maybe they don't have enough trade line history to qualify for the program that they want. And so maybe they need a little bit more time to gain that credit history, or maybe they need to get an authorized user account to help grow their credit. So these are the types of things that we can uncover in the pre-approval process. So even though the willingness of the buyer is there, the ability to qualify may not be there. And so again, we want to know that stuff so we don't waste our time going through the process with a buyer that may not be qualified. But it's not a waste of time going through the process because we're getting that buyer into a position and we're coaching them and educating them on what they need to get into a position where they can qualify. So a lot of times we work with buyers for several months until they get into a position where they can qualify for a home. And that's just the way that the process works. So before you go through that process, you don't necessarily know that you have to source all your down and have certain trade lines and all these things that you need to know to qualify for a home. And that's what we pride ourselves in, is educating buyers and agents into what it takes to get into a position to qualify. So here's what we talked about is taking that one step further to going into the underwriting process and having that TBD approval. This results in a faster closing, and you can almost compete with a cash offer, because if you don't have loan contingency, you're essentially saying that we're already approved and we're not worried about the loan offer. And so you're basically competing with cash offers, which in this market can be very powerful. Does anybody have any questions on that TBD approval or that process? No? Okay. All right, so here's a little information on credit. It looks like we have a question. So Mary's asking about trade lines. So yeah, on your credit, and we'll talk a little bit about this right now. So depending on the type of program that you're trying to get, there are certain trade line requirements. So like Jumbo, for example, you might need, 3 trade lines that have been open for at least 24 months. So that means you need, a credit card open for at least 24 months. Maybe you have a car loan that you've had for 2 years, and maybe a school loan. So that would be 3 trade lines. So that is a requirement on certain loan programs, and a lot of people are not aware of that. And so that's something that we try to educate buyers on when we're going through the pre-approval process. So as you look at the slide, you can see that your FICO score is made up of 5 areas. One of them is the payment history. So that's the largest factor that goes into your score, which essentially is telling you what your credit worthiness is, right? Because if you're not making payments on time, you're telling the creditors that you're not credit worthy, or that you are not going to make your payments on other trade lines on time either. And so it's really important that you just make your payments on time, because 35% of your score is comprised of that payment history. The next largest portion is the amount that you owe. This is especially true on revolving or credit card accounts. So if you open a credit card account and you have a $10,000 limit, and you go out and spend that $10,000 and you max out that credit card, that's telling the bureaus that you have a high propensity to go out and get into debt. And so that will drop your score, because if another creditor issues you a credit card, if that card is maxed out, then they will typically tend to believe that that next credit card will be maxed out as well. And so a goal is to try to keep your revolving balances at 30% or below of what the max trade line is. So if you have a max 10,000 limit, you want to keep that balance at 3,000 or below. If it goes over that amount, it will tend to start to drop your credit score. Okay. The length of your credit history is the next section, and that comprises 15% of your FICO score. So somebody that tends to have a longer credit history and more history of making payments on time will tend to have a better credit score than somebody that just opened their first credit card, because the bureaus don't have enough time to know whether you're going to make your payments on time for a long period of time. And so the longer history that you have with no late payments, the higher your score is, because you've shown that pattern for a longer period of time. So that's why I try to tell people that it's important to teach your kids at a young age the importance of credit and establishing their credit early on, so that they have a longer credit history. And then finally, the credit mix is 10% of your score. And that's just basically what different kind of accounts do you have? Do you have all credit cards? Do you have car loans as well? Do you have other installment loans like school loans that you've paid back? Do you have a mortgage, or have you had a mortgage in the past? So if you can show good history with the different kinds of credit accounts that are available, like revolving, installment, and mortgage accounts, that shows that you have the ability to manage the different kinds of credit that is available to you, and that will also help improve your score. I think we've got a question. So there's a question about a no-doc loan. We'll get to that later when we talk about loan programs. Do utilities show on trade lines? So that's a good question. Utilities do not show on trade lines, like gas, electric, water. Cell phones do not show on credit reports, but there is something called Experian Boost. This is a service that Experian offers where you can go on to their website and go through the Experian Boost process. And that's where you can actually take utilities like water, gas, electricity, cell phone, cable bills, and you can get those added to your report, and that will help boost your score, hence the name Experian Boost. And a lot of times, if we're working with buyers and they need a little bit of a boost in their score, we'll have them go through that process to add those utilities trade lines to their account so we can help bring their score up. So that is one way that I was going to mention on how you can improve your score. Other ways that we can help is we have a system or software through our credit reporting agency called Wayfinder, where it will take a buyer's credit score or credit report and tell us certain things that we can do to help improve their score. A lot of times that requires them to pay off accounts. Unfortunately, many people carry high balances or maxed out balances on their credit cards. So a lot of times just paying down revolving accounts will help boost your score, and usually boost it quite a bit and very quickly. So that's one way. Another way would be to potentially try to dispute or remove late payments or collections. A lot of times if you call collection companies and try to negotiate with them that you will pay the account off in full, sometimes you can get them to write letters that the account has been deleted or has been reported in error, and we can get those removed, and that can help raise credit score as well. Reducing the amount that you owe, that goes hand in hand with paying down revolving accounts. Paying bills on time, that might seem obvious, but a lot of people get into a pattern of just making late payments. And so it's important that you stress to them that, like, hey, if you want to show the bureaus that that pattern has changed, then you're not going to continue doing that. You have to start making payments on time, but continue making payments on time, because if you then make payments on time for 6 months and then make another late payment, your score will improve, but then it'll drop right away back down to where you were before, because you're just proving to them that you're falling back into that old pattern. Closing old accounts actually hurts your score. So we try to coach people that if you want to stop using an account, to just pay it off, cut up the card, but don't close it, because, you know, going back to what makes up your score, 15% of your score is made up of the length of your credit history. And so if you close a very old account, you could be deleting a long history of an account that you had positive payments on. So that could actually drop your score. So we try to tell people not to ever close any accounts, but to just cut up the credit card. Adding an authorized user account, that's another way that you can help by maybe getting on your parents' card or your spouse's card that has good credit history. And that can help add a positive account to your report that will help boost your score. And then another thing that we advise people to do is to check your report at least once or maybe even twice per year. We are in a time where email scams and phishing and fraud is very prevalent. And a lot of times people have fraudulent accounts on their report and they don't even know about it. So if you don't know about it, you can't address it. So by checking your own credit, going to annualcreditreport.com, or there's many other credit monitoring services that are available, you can be aware of what's on your report so that you can get it resolved as quickly as possible. Somebody asked, what is new credit? So I think the new credit is part of your score. And what happens is if you open a new account, specifically like a revolving account, that shows the bureaus that you now have a new credit card that you could use to get into more debt. And so typically when you open a credit card, your score will drop initially. As time goes on and you show the bureaus that you have the ability to manage that new account and you're not going to go out and max that credit card out immediately, as you make positive payments on time, your score will start to improve. But opening new credit card accounts will typically drop your score initially. So when people are in an escrow or going into the process of getting pre-approved, we advise people not to open any new accounts because that will typically drop your score. Mary has a question about where can you appeal if a lender won't recognize a past error in payment timing? So lenders will only look at what's on the credit report. If you have a late payment on your credit report, which is giving you, a 650 credit score or whatever the credit score is, the only way that the lender will recognize a correction in that is by us getting either a credit rescore or a credit supplement. So what that means is the buyer has to get a letter or something in writing from the creditor stating that that payment was made in error or was never late. And then we send that to the bureaus to get the credit report corrected. And a lot of times do what's called a rapid rescore, where we can actually get the score to reflect the correction and will usually result in the increase of the credit score. Without that, the lender can only go off of the current credit report. So without actually fixing it at the bureau level, it's not going to be recognized by the lender. Does that make sense? Okay, there's another question about how do you stop credit card companies from closing accounts from non-usage? This typically doesn't happen. I have 10 credit cards from like 20 years ago that are still open. Credit card companies don't like to close accounts because for them, that means that they're closing a potential card that might still be out there floating that you might use one day. So my personal experience is that they don't typically close accounts. Yeah, you might have a couple companies here and there that, if you don't use it, they'll send you a letter and say, hey, if you don't use this account, we're going to close it. That might have happened to me once in the entire history of me having credit. My experience is that they typically don't want to close credit card accounts. So if you do not close the account, they typically will not close it. So that's been my experience. Typical timeline for new credit to pass the threshold for dropping score. I would say it's probably somewhere around like 3 to 6 months. So when you initially open a new credit card, your score will drop. And then once you start using and making payments on that card, typically within 2, 3 to 6 months, you'll start to see the improvement and the score trend back upwards. So that's typically what I've seen in my experience. Let me see if we have any other questions. Okay. So somebody had two people had a question about the TBD. TBD stands for to be determined. So when we're going back and doing the TBD approval, what we're saying basically is that we're submitting the loan with a to be determined address. So that means that the buyer does not have an accepted offer, they're still shopping for a property, but we still want the lender to underwrite the entire file as if they've picked out a property. So it's the address is to be determined, but they're still calculating the income, they're still looking at credit, they're still verifying the source of down payment, and they're approving the loan, but they are recognizing that we don't have an address picked out yet. Okay, so the benefit and the power in that is that we already have a loan approval. So you can submit your offer telling the listing agent that we already have an approved loan, and that the buyer is not contingent on you getting loan approval. So you're already signing off that there's no loan contingency. And so what that says to the seller and to the listing agent is that they don't have to worry about whether this buyer is going to get approved or not, because you already have a loan approval, right? Okay. So Manoush is asking, if I need to get rid of the credit card fee and need to close it, what is my alternative? Yeah, that's understandable. If you have a card that has an annual fee that you want to try to get rid of, at that point, yeah, your only option might be to close that credit card. It's okay to close an account. We just advise that it's better not to. But yeah, if you need to close that one account, that's okay. You just don't want to go and start closing all your accounts, because essentially what you're doing is you're literally eliminating that history from your credit report. So if you have 5 credit cards and you're not using them, and you go and close those accounts, you're not going to have any credit history. Same goes for, again, if you have those 5 cards and you're not using them, guess what? The bureaus don't have any payment history to score you off. So if you don't have accounts and you're not using them, your score will start to drop, because the bureaus don't know what your credit worthiness is, because you're not using your credit. So I tell people, if you're using your card, don't pay it off in full every month, because if you use your card on the 1st of the month, and let's say you buy groceries with it, and then you pay it off before the end of the month, the credit bureau looks like as if you're not using that card, because you used it, but you paid it off. So every month it's not reporting any balance. So what I tell people is to use the card, but if you want to pay it off in full and not incur any interest on the card, just leave a $10 or $15 balance. And so every month it's going to report a $10 balance, but it shows that you're using it and making a payment on it. And so that'll keep your score up versus paying it off every month and not having any history for the bureaus to judge you on. I hope that makes sense. I have another question on the TBD approval. How is the issue of appraisal gap addressed? Would you still need an appraisal contingency? Good question. So the appraisal can't be addressed, obviously, because we don't have an address. The only time that the appraisal value or gap or appraisal waiver can be known about is once you have the property picked out. So appraisal waiver, for those of you that don't know, on a property that's worth $1 million or less, when we run it through the automated underwriting system, it will tell us if we need an appraisal or not. So if you put a certain amount down and, based on your other qualifying factors and whatever information that Fannie or Freddie have on that property based on past title information, like, comparable closings in the area, there's a chance that you may not need an appraisal at all. So that's another important reason why the pre-approval is so important, is that the lender can talk to you as the agent and let you know whether you need an appraisal or not. And so not just going in with waiving appraisal loan contingency, you could potentially waive appraisal contingency as well if you have an appraisal waiver. And that again helps your offer be stand out more against the other offers. So Mary is saying lenders and agents should make buyers aware of the secondary market and that their loan may be sold. I had no clue in the past, as my prior loans were from big banks, and by the time I figured out Payments was missed. Yeah, so that's a good point. Typically, any loan that you get or your buyers get, the lenders reserve the right to sell or transfer that loan. The only loans typically that are not sold or transferred are portfolio loans that you might see from like credit unions or like private lenders. But for the most part, even the big banks, you know, Chase, Wells, all the brokers, all those loans have a document in there when they sign the loan docs. It's called the transfer or servicing disclosure statement, where they reserve the right to sell or transfer the loan. Most of these lenders, they have requirements where they have to give you a grace period, typically of 60 days. So even if you make your payment to the old lender, they have to accept them, and they have to notify you by in writing. So yeah, there are requirements. They can't just hit you with 30-day and 60-day late payments on your credit report. But you also have to pay attention if you get that disclosure or that notice that your loan is being transferred. You do have to start, you know, eventually sending payments to the new lender. Okay, so any other questions on credit scores? All right, so we're kind of, I think we're a little behind on time, so we'll skim through some of this stuff. Manoush, you're saying, can you please explain the late payment benefit again? I'm not sure if I understand your question. There's no benefit to making late payments. Maybe if you can rephrase that a little bit so I can understand what you're asking. Okay, so some of the common mortgage mistakes. Okay, so Manoush is saying, what's the benefit to leaving $10 or $15 on your credit? So I'm speaking specifically to the people that use their card and pay it off every month. If you use your card and you pay it down to 0 and you pay that before the creditor can report to the bureaus that there's any balance on your account, it's going to look every month that you don't use your card because you're using it and paying it off in full. So you're not acquiring any positive payment history with the bureau because it looks like you're not using your card. So to the buyers that don't want to pay any interest on their card and pay it off in full, you're not doing yourself a benefit. You are by not paying interest, but you're not gaining any positive payment history. So you want to leave at least a very small balance on your credit card so that they can report to the bureaus that you're actually using it and making payments on time. Without showing the bureau that you're making payments on time, you're not showing them that you have the ability to manage your credit. I hope that makes sense. Okay, so on to common mortgage mistakes. This is what we kind of coach people on as they're going through the pre-approval process or in the escrow process once they have an offer accepted. So the biggest thing, like we've mentioned, is large purchases or opening new credit card accounts. Those things are gonna, first of all, lower your credit score. And if you haven't locked in your rate yet, the credit score will typically affect the interest rate. And so you wanna make sure that you have the highest rate possible to secure the best rate for your loan. The other thing that large purchases does is it affects your debt to income ratio. So, you know, a lot of people get excited. They've got the new house and they wanna buy the new car. And, you know, they're not taking into account how that new payment is going to affect their qualifying and their debt to income ratio. So I can tell you many, many times from experience, one of the common things that people have issues with in terms of qualifying is they don't qualify a lot of times because they have a high car payment. And I'll tell them, hey, if you can sell your car or pay off your car or refinance to try to get a lower payment on it, that might help you qualify. And so we urge people not to make any large purchases as they're going into the pre-approval process, or a lot of times people do that once they've already got an accepted offer. And that's kind of like worst case scenario because we've already put the deposit down on the home and we've gone through underwriting and now they've made a large purchase and we need to scramble to try to pay off that account or, refinance the car into someone else's name. And so it can cause problems, and it's a common thing that we see. And so that's why we do mention it and talk about it. Another thing is co-signing for somebody else. So you may not buy a car for yourself, but maybe you want to co-sign for your son, another family member. Maybe you've got another person trying to qualify for a home, and so you qualify for them, or you co-sign for them on a car loan or a school loan. So that's another thing that can commonly cause an issue and will affect the debt to income ratio. So that's something that we mentioned. Changing jobs a lot of times can cause an issue where you maybe don't stay in the same line of work. That's a problem because lenders need to see that you've been in the same line of work for at least 2 years. So you can't go from, selling insurance to now you're going to go into the construction business and work for a contractor and start laying tile. You may hate laying tile after 30 days. And, you need to show the lender that you can do that line of work for at least 2 years and show, security and consistency in that new line of work. And so if you are going to change jobs, it's okay. You just need to make sure that you stay in the same line of work and that you're consistent in your pay structure. So you can't go from being a W-2 employee to being paid 1099 as a contractor, because you also need to show a 2-year history in being self-employed. So again, self-employed businesses typically fail within the first 2 years. And so you need to show that you can do it for at least 2 years in order for the lender to be able to use that income to qualify. So if you're switching from 1099 to being W-2'd, that's okay, again, as long as you're in the same line of work. So if you're, an independent contractor and you are building homes and you're now switching from owning your own business to working for a home builder, but you're still, a project manager or a contractor for them, and you went from being 1099 to now you're getting a W-2 salary, that's okay. You just can't go the other way around because you need that 2-year history, okay? Sourcing of money and down payment is also a common problem. You cannot cash advance credit cards for earnest money deposit. You cannot deposit mattress money or cash that you have laying around at home, because you cannot source that money and document where it came from to the lender. So that's a common conversation that we have with buyers as well. Another thing that we talk to buyers about, especially in this rate environment, is just fluctuations in interest rate. As you saw from the previous example, interest rates have been fluctuating a lot and they can go up very rapidly. And so a lot of times we're communicating to the buyer and also to you as the agent that, hey, this buyer's qualified, but if the rates go up, even 0.25%, they're not going to make the debt to income ratio requirement. And so it's important for you as the agent to know what the absolute max purchase price is for your buyer, so that you guys aren't putting out offers that are over their qualifying limit. And it's important for us to work with the agent as a team and the buyer, so that they feel like everybody's on the same page and that we're working as a team and everybody kind of knows what the limitations are, what the strong points are in the file. And so you guys kind of know what to emphasize in your offer and when you're showing properties. Okay, so those are some of the common mistakes. Any questions on that? Okay, now kind of onto the loan process. So I'm going to try to skim through this a little bit quicker. So the overall process is, the buyer we're assuming is pre-qualified. They've already got their offer accepted. Now what we're going to do is we're going to reach out to the escrow company that is been assigned on the file, and we're going to get a breakdown of the fees from them. This is what will allow us to create the initial disclosures. The loan process cannot really start until the initial disclosures have been sent out to the buyer and they've been signed. One of the forms in that disclosure is the intent to proceed. So that's where the buyer is authorizing that we have the intent, or they have the intent to proceed with the loan process. That's what allows us to submit the loan to underwriting. That's what we need signed before we're able to order the appraisal, if there is an appraisal required on the file. So the initial disclosure process is important because it also notifies the buyers what the fees are going to be. It gives them what the payment breakdown is in writing. So all that stuff's really important for the buyer to understand and know what they're getting into. From there, the loan gets submitted to underwriting. And if we don't have a TBD approval already, this is where the underwriter is going to review all their documentation, their pay stubs, their tax returns, their bank statements, and go through the actual underwriting process. At this time, we may decide, to order the appraisal, or if the file is challenging, we may decide that we want to wait until we get loan approval before we have the buyer order the appraisal, because typically they are paying for the appraisal up front. And so we'll make a decision with the buyer and with the agent at that time when we're going to order the appraisal. Sometimes the escrow is very short and we need to move very quickly. And so we're just going to order the appraisal right away. And so we'll just make a judgment call on that. At this point, we'll typically receive the conditional approval. Most lenders right now are running anywhere between 1 and 2 days in underwriting. So the loan approval should come out rather quickly. This is where we'll get what's called a conditional approval. The lender will tell us that the loan is approved, but there might be some conditions that they need. Typically, they might ask for, maybe there's some deposits on the bank statement that they need to source. Maybe they need an additional pay stub. Maybe there's something having to do with their pay that they need explained, or if they're self-employed and there's been a reduction in the income, they need an explanation as to why the income has gone down. These are all examples of conditions that might be listed on the conditional approval, okay? So we'll go over those conditions with the buyer and typically send out a conditional approval in writing. And as we go through those conditions and start to submit them to the lender will go through and sign those off. And once all the conditions are signed off, we get what's called the final condition, or the final approval, or the clear to close. So you might hear that clear to close, or CTC, sometimes it's referred to. That's good news. Once you get the clear to close, you're in a good position to draft your final loan documents, and they'll get sent over to escrow, where escrow will prep them, and they will send out a final estimate, which we will then send to the buyer. We'll go over the final estimate, tell them how much money they need to wire into escrow to close. And we'll also go over the actual loan documents with them to go through their payments, their promissory note, when is their first payment due, so that when they sit down with the notary, there's no questions, right? It's always difficult to get a call from a buyer when they're sitting with the notary and they haven't seen any of this information before, and there's all these questions. And so the last thing we want is to have that situation unfold. And so we always like to keep our buyers informed and let them know all those details before they sit down to sign on the dotted line. Once they sign the loan docs and wire their money, we'll get the loan funded and get the deed recorded with the county. And that's always my favorite part, is when I get to call the buyer and let them know that their loan is funded and the transfer has recorded with the county, and then you guys can meet the buyers and give them the keys. And it's always really exciting to help someone, attain that home ownership dream. And that's kind of what makes our job rewarding. So we can achieve all this in today's market in as little as 14 days. We've done it quicker. I've had loan closings in as little as 8 days. But yeah, we can accommodate all your timeframes. So any questions on that loan process? Okay. Okay, and then before we get into the loan, the sources of financing, we are going to talk about, I'm going to pull up the temporary buy down. Okay, can you all see this on my screen? Okay, so in today's market, we talked about affordability, and so the rate and the payment tends to be the biggest objection from buyers. And so there's really two ways to bring that rate down. One is by doing a permanent buy down, where you pay discount points on the loan, and that lowers the interest rate for the life of the loan. So what that means is if the rate today is 6.5%, the buyer could pay 1 point. Let's say their loan amount is $500,000. 1 point is equal to 1% of the loan amount. So that $5,000 gets charged through closing as a closing cost, and that might bring their rate down to 6.25% for the life of the loan. So for the entire 30 years of the mortgage. The other option is to do what's called a temporary buy down. So a temporary buy down is just that. It's a buy down on the rate, but it's temporary. You can have a 1-0 buy down where you buy the rate down for 1 year. You can have a 2-1 buy down where you buy the rate down for 2 years, or you can have a 3-2-1 buy down where you buy the rate down for 3 years. So we'll look at the 2-1 buy down scenario. So this was a scenario that I recently had. The purchase price was $800,000. They were putting down 20%, so their loan amount is $640,000. The current interest rate was 6.75%, and they were asking for a $15,000 credit from the builder to use for a temporary buy down. So what that means is the first year, the rate goes down 2%. So that's where the 2 comes from. So the first year, the payment goes to 4.75. Let me make this bigger here. So 4.75. And you can see here, the payment at 6.75 is $41.51 a month. And the payment the first year is $3,350.38. So that equates to a reduction of $813 a month for the first year. The second year, the rate is 1% less. So now you're going from 4.75 to 5.75. And then the last year, it goes back to the original note rate of 6.75. So essentially what you're doing is you're lowering the payment for the first 2 years to help ease the payment and the higher interest rate environment that we're in. Now, the reason why this program is more beneficial than a permanent buy down is because you're using, so you can see the cost here, right? The cost, the first year is $9,750. The second year, it's $4,900. So the total cost is about $14,700. And we're using the incentive or the credit from the seller to pay for this program. The reason why this program is more beneficial than paying points and permanently buying down the rate is because we all know that rates are going to come down. And when the rates come down and the buyer refinances, they're not going to walk away from all this money. So for example, let's say that they refinance at the end of the first year. So they've already used up $9,700 and they still have $4,900 left in the account. When they refinance, that money is going to go towards paying the existing loan balance down. So they're not going to walk away from that money. When you pay points and you buy the rate down permanently, let's say that you pay $5,000 and you buy the rate down permanently, that gets, paid up front and used right away and amortized over the life of the loan because the rate is bought down permanently over the 30 years. When you refinance, if you have not reached that break-even point to recuperate that money, the buyer's essentially walking away from that money. And so it's money that's thrown away essentially. And since the likelihood that buyers are going to refinance in the next 6 to 12 to 18 months is very high, this is a way to get first of all, get a much bigger reduction in the monthly payment over the first, second, or third year of the loan, but also still use the money and not walk away from it if and when they do refinance. Any questions on how that program works? Feel free to reach out to me directly. Elsie can give you my contact information. I'll have it at the end as well. If you have any questions or have any buyers that might benefit from this program. Okay, back to the slide here. Okay, so looks like we've got some questions. Season funds, how long does the cash need to be deposited before it considered seasoned? Good question. So season funds is typically 2 months. So you want to have, if you have to deposit cash, it needs to be there for at least 2 months before it can be seasoned. And the reason is because when we go to submit the loan, the lender is going to require 2 months of bank statements for each account. And so once the money's in there for 2 months, the 2 months of bank statements are not going to show that cash deposit anymore. And so the lender is not going to question where that deposit came from. So that's why the 2 months is the timing that's required in order to season funds. What is a closing disclosure? So a closing disclosure is the kind of like the final estimate. Once the loan terms are finalized, the lender must send out the closing disclosure, which tells the final terms of the loan. The buyer must sign that document. And the reason the closing disclosure is important is because once the buyer signs it, we have to have a 3-day wait in order to wait before the buyer can sign the loan docs with the notary. So it's kind of like a cooling off period. So the reason that that's important is because it might affect your closing date. If the lender does not get the closing disclosure out in time, then it'll delay your closing. Let's say that you're supposed to close, today, and the closing disclosure was sent out yesterday. Well, the 3 days has not elapsed. So you're not going to be able to close today because the earliest that the buyer will be able to sign their loan docs would be on Saturday. So that's going to push your today closing into next week. So it's really important that your lender is, doing everything in a timely manner, and because if not, the closing disclosure could delay things. Okay, in the process, the loan is issued to the buyer, then the buyer wires the money to escrow. Yeah, so once we have final loan approval and we have final loan docs, typically we tell buyers to wire the money to escrow about 1 to 2 days prior to closing escrow. And we do it 1 to 2 days before because we want to make sure that escrow can confirm they received the wire, to make sure that that's not going to hold up closing. Okay. Okay, so there's I guess somebody's confused about the 2-1 temporary buy down. I'm not sure if there's a question there. If you have a specific question, let me know and I'll try to address that. Mary's asking, does it only make sense to do a temporary buy down if you are receiving a seller credit? No, it really depends on the buyer's situation. And that's where the experience from the loan officer can help guide and coach the buyer to do the best thing with the seller credit. Because let's say that the buyer is elderly and they're going to be retiring after they close escrow. And so a refinance may not be possible because they might qualify now, but after they close escrow, if they retire and they go into like a fixed income and they're not going to be qualified for a refinance, a permanent buy down might be a better scenario for them because they might not be able to take advantage of a refinance down the road. And so a permanent buy down and using the seller credit that way might be the best case scenario. So that's just one example of where a permanent buy down might be better than a temporary buy down. Or if you think that maybe the rates won't go down, maybe a temporary buy down isn't the best situation for you. So There's many different scenarios, and that just comes from experience and talking to the buyer and finding out what their financial goals are to determine what's the best way to spend that seller credit. And that's a conversation that we include the agent in so that they understand. Maybe we have to draft up an addendum on how that money is going to be spent. And so again, it goes back to talking and communicating in a team so that the buyer feels like we're all working in conjunction to best serve their needs. Okay. Okay, let's jump into sources for financing. So you've got your traditional banks and credit unions. So those are going to be your brick and mortar banks that you see every day: Chase, Wells Fargo, B of A, the credit unions like Schools First, Connecta. These are or can be good sources. They tend to take a lot longer to process loans. So there's definitely pros and cons. You know, the credit unions and portfolio lenders, they might have proprietary programs that other lenders don't have access to. And a lot of times they might have more aggressive rates on certain programs. They also tend to be more aggressive on jumbo loans or ARM products. So that can be a benefit on that side. But they oftentimes also have tighter guidelines, especially for portfolio programs and jumbo programs. They typically have higher credit score requirements. They typically have higher reserve requirements. So you have to have more money in the bank at closing than other lenders. So those are your typical brick and mortar type lenders. Then you've got mortgage bankers. So those are going to be your big name recognition brands like Rocket or Guaranteed Rate or Loan Depot. So those are big retail or wholesale lenders that fund the loan in their name, but then they will sell the loan off basically immediately after the loan funds. So the benefit is, I guess, the name recognition. A lot of times they do have higher interest rates because they tend to be very large companies. They have lots of overhead. Not to say that they don't do a good job, but I'm just pointing out some of the pros and cons of the different lending sources. And then finally, you get to the mortgage broker, which is the way that we're set up. TrustLink Mortgage is a broker. And the benefit is that we tend to have access to all of the above. So we can actually broker to people like Loan Depot, Rocket, Guaranteed Rate. We can broker to the banks like Wells Fargo and some of the credit unions. So we have the access to all the programs. We're able to shop for the best rates. And because we tend to be on the smaller side, the margins associated to our rates tend to be lower. And so we tend to be able to deliver the lowest rates out of all the three platforms. I've been in all three. So I've worked for a bank. I've worked with Bank of America and Wells Fargo. And I've also worked as a mortgage banker through the platforms that were offered with the builder. And now I'm structured as a broker. So I've had the benefit of kind of experiencing all three. And, you know, another one of the benefits of the broker is that we're local to the market, right? So I'm an affiliate of OCAR. I'm here in the area and I'm familiar with the different markets that you guys are selling in. And so I do think that that's a big benefit to working with somebody that's local to your community. So those are kind of the three primary sources for lending in today's market. So going back, I had a question on the rate buy down. Is that an option on a refinance? Yes, you can do a rate buy down on a refinance. So you can do the permanent buy down. I don't think that the temporary buy down is offered on the refinance. I believe that's only on the purchase. I have another question on what is portfolio lending. So great question. Portfolio lending is typically done through a bank or a credit union. So let's just take, for example, Schools First. Schools First might have a program that only Schools First offers. maybe there's a specific guideline that they have created, and they are going to lend the money for that loan. It's their money. It's the depository money that the members of Schools First have put into the bank, and they're going to fund the loan with their money, and they're going to service that loan. They're going to collect the payments. They're not going to sell the loan or transfer it to anybody. That mortgage is going to be created, originated, and funded by Schools First, and it's going to be serviced by Schools First. So that's a portfolio program. It's created by them, funded by them, and serviced by them. And it's not available anywhere else because it's their program. They created it. So they might have like a zero down option or something specific to their lending that they want to offer to their members. So that's one example of what portfolio lending is. Hopefully that answered your question. All right, so now we get into the loan programs themselves. What types of programs are available? And so you've got conventional loans, which are kind of like your plain vanilla 30-year fixed through Fannie and Freddie. You've got FHA loans, which are government insured loans. You've got VA loans, which are also government insured, but for veterans only. Then you've got jumbo financing. Then you've got home equity lines and second mortgages. And then you've got your alternative programs like the no-doc loan that somebody had a question about earlier on. And we'll kind of get through all of those. So conventional financing, again, these are loans that are through the government, well, actually private entities, Fannie and Freddie Mac. They're government sponsored. And those are going to be your typical, fixed and adjustable rate mortgages on 1 to 4 unit properties. They can be used on primary, secondary, and investment occupancy types. Their financing limits, they'll go all the way up to 97% financing for primary residences, so 3% down. Those are up to the conforming loan limits. You can go up to 10% down on second homes, and the investment homes, they used to do 15% down, but nowadays with the rates, you're really going to be looking at 20, and in some cases even 25%, depending on what the rate is and how it affects the qualifying. On these loans, the max debt to income ratio is 50% and typically a minimum FICO of 620. If you have less than 20% down, you will be required to pay PMI. On condos, they do require condo project approval. So there's different requirements that Fannie Mae needs to have condo projects approved. And we'll go through that process. Sometimes there's already an approval in place, but if not, we'll work with the management or association to get the documents needed to go through that process. It's just part of the loan process when you're purchasing a condo. This is also, I apologize, this is outdated. The current loan limit in Orange County is $726,200. That's the conforming limit, and the high balance limit is $1,089,200, or I'm sorry, $300. So definitely there's a higher loan limit here in Orange County. So somebody asked, can you explain what a mortgage banker is? So good question. A mortgage banker is similar to a broker, but the difference is that they have credit lines in place where they are essentially funding the loan in their name. So Loan Depot, for example, they're going to fund the loan as Loan Depot using the credit line, but then they're going to immediately sell the loan to another bank or to Fannie Mae directly, and that new lender will take over the servicing of the loan and collect the payments because they need to pay off the credit line. A mortgage broker is different because we're not closing the loan in our name. We're closing the loan in the name of the lender that we have connected the buyer to. So if we're brokering to Chase, the loan will be funded in the name of Chase. We're not using our own money to fund the loan and then selling it to Chase. So hopefully that answered your question. Okay, so that's conventional loan. The next type of loan that we have in today's market is FHA financing. So This stands for the Federal Housing Administration. It's a loan that's insured by the federal government. It also offers fixed and adjustable rate mortgages, although I've been doing this for 22 years and I've never seen an adjustable rate FHA loan. So it's pretty much always a fixed rate loan. They're available on primary residence on up to 1 to 4 unit properties. And this allows for as little as 3.5% down. And one of the benefits of FHA is that they will go higher on the debt to income ratio up to 55%. And they'll go a lot lower on the FICO score. So it'll go as low as a 550. So it does allow for credit challenge buyers and buyers that have lower income because of the higher debt to income ratio. It does have monthly mortgage insurance, and it also has an upfront mortgage insurance premium. So on FHA, you have a 1.75% upfront mortgage insurance, which is typically added to the loan. And then you also have the monthly portion. So you have both on FHA. FHA is also more lenient on credit events like bankruptcy and foreclosure. You can typically requalify after one of these events more quickly than you can for a conventional loan. So that's another benefit. And rates are typically lower than conventional financing. So if you have a buyer that's considering a low percent down, like 3 or 5%, and especially if they have a lower credit score, FHA will typically always be a better option because the rate is much lower. And so even though the MIP, the monthly mortgage insurance, is more, because the rate is so much lower, it typically will offset that and will tend to have a lower payment option for the buyer. Okay. Next, we get into VA. So VA financing is for veterans through the Department of Veteran Affairs. It's available to veterans, people currently serving, or even surviving spouses of veterans. It allows for fixed and adjustable rate mortgages, but again, I've never done an adjustable rate VA loan, so they're typically almost always fixed rate, and they are available for primary residence on 1 to 4 units. The cool thing about VA is that they allow for 0 down. So if you're working with a veteran, there's typically no reason to not go with a VA loan. The rates are a lot lower than conventional. They're typically right around the same as FHA, and they don't have any monthly mortgage insurance. So we love working with veterans, and it's a very good loan program. The debt to income ratio, similar to FHA, does allow up to 55%. In some cases, it can go higher depending on the compensating factors. So if you have more income, or I say residual income, if you have good credit, if you have reserves, sometimes it can go higher than a 55%, and they'll go down as low as a 580 on credit score. They do have a VA funding fee, so they don't have monthly MI, but similar to FHA, they do have a funding fee that gets added on to the mortgage. However, that can be waived if the buyer has any type of a disability rating with the VA. And that's something that we typically go through on the pre-qualification process. As I mentioned, interest rates are significantly lower than conventional financing. What criteria to qualify for any? Yes, anyone can apply for FHA. It just has to be owner occupied. So you just have to put a minimum of 3.5% down and meet the debt to income ratio requirements. So somebody had a question about high balance. So high balance, in Orange County, we have the conforming loan limit, which is $726,200. But in Orange County and in other counties like LA, you can go up to the high balance limit, which is $1,089,300. You can go up to that limit before you reach the jumbo loan limit, which is I'm going to cover now. So the reason that that's beneficial is because a lot of times jumbo will require more down. They will require higher credit scores. They will require more reserves or money to be left in the bank at the time of closing. So if you can qualify for conventional or high balance, a lot of times it's more beneficial than trying to go to a jumbo lender. So as you can see from the screen, jumbo is typically sourced from banks or credit unions, but as a broker, we also have jumbo options. They do come in fixed and adjustable rate mortgages, and oftentimes they'll also have interest-only options. They do offer them on primary, secondary, and investment occupancy types. Some lenders, like credit unions, they will offer as little as 3% down for primary. You can go 10% for second and 25% for investment. Loan amounts will start over the high balance loan limit. So $1,089,301 is jumbo, and anything above. And the max debt to income ratio is typically around a 43%, but some lenders will go as high as a 50. And typically the minimum FICO that we see for jumbo is 680. So definitely a higher qualifying requirement for jumbo. When you have less than 20% down, mortgage insurance is not always required. And typically you'll see reserve requirements anywhere from 0 to 36 months. The average is anywhere from 6 to 12 months. So if your monthly mortgage payment is $10,000 a month and the lender requires 12 months of reserves, that means that you will need to show $120,000 in the bank after your down payment at closing in order to qualify for a jumbo loan. So that's what reserves are, okay? Any questions on that? Okay, next we get into home equity lines and second mortgages. So I guess talking about the high balance limit, sometimes if the buyer does not qualify for jumbo, or if you're working with a buyer in Riverside County, for example, the loan limit out there is only $726,200. Anything over that is jumbo. So if you're working with a buyer that maybe doesn't qualify for jumbo, or there are not a lot of jumbo options in Riverside, which tends to be the case, you can split the loan up into a first and second. So what you can do is you can get your first loan at $726,000, and then you can put a home equity line or a fixed rate second mortgage behind that first loan. And that's how you can maybe accomplish a 10% down payment in Riverside County, where you may not have a good jumbo lender option. And that's actually a deal that I'm working on right now. We have that exact scenario. We're working with a lender doing a first and second loan in order to achieve a 10% down payment in Riverside County. So that's one of the main benefits of the home equity lines, is being able to pair it with a first loan so that you can accomplish a lower down payment option in a county or an area where maybe the buyer doesn't qualify for the jumbo loan. Another benefit is that when you do that and combine it with a first loan, yes, you have a payment on the home equity line, but you're eliminating the mortgage insurance that would be there because they're making less than a 20% down payment. So that's another benefit that we often see. Again, it can help qualifying counties with lower limits. You can go up to 95%. So in some instances, you can do as little as 5% down by using a first and second. You can also use it to tap into your home's equity. So maybe if you have a really low rate on your first mortgage and you don't want to do a cash out refinance, but you want to tap into your home's equity, you could use a home equity line to access that money and use it for home improvement projects. You can use it, as a down payment for another property that you want to buy. You can use it to pay your, your kids' education or college. So there's a lot of great ways to tap into your home's equity by using a home equity line. Okay, and then finally, we get into the alternative programs, and we're seeing these a lot today in today's market. So I think the most common one is people that are self-employed and they have a lot of write-offs or deductions on their tax returns, and they don't have the ability to qualify on paper. You can use a bank statement loan where we will take a look at 12 or 24 months of the buyer's bank statements to take an average of what their deposits are. and you can use that as qualifying income. So that's a common program that we're using for self-employed buyers in today's market. Another common program is what's called a debt service coverage loan. What that is we're basically using the proposed rental income on the property, on an investment property, to help qualify for a loan. So that way you don't need to document any income. You're using the proposed rental income on the subject property to qualify, okay? We also have down payment assistance programs. We've got asset depletion programs where you're using, let's say they have an account with a large amount of money in it. We're using that to show that as a payment stream, to use that as income to qualify. We've also got long-term lock programs and the temporary rate buy down program that we talked about. So these are all programs that we're using to help buyers qualify and make sure that we're giving them the right financial tool for their situation, okay? Somebody asked, what is interest only? So interest only is basically, on a traditional loan, you're making principal and interest, so that, you know, starting with the first year of the loan through the 30 years of the mortgage, you're slowly paying down the principal on the loan, so that at the end of the 30-year loan, the loan is paid off. Well, interest only is where you're only paying the interest on the loan. So every month, the loan balance is staying the same. So essentially, you're just using it as a tool to help lower the monthly payment obligation on the loan, so that you have a lower monthly payment. Okay, so that's what interest only is. But at some time, the interest only ends. So typically interest only is only available for like 10 years. And then after the 10-year period, it turns into a repayment. So typically that the payment would jump up, because now instead of a 30-year loan, you have a 20-year loan, but for the first 10 years, you haven't paid down any of the balance. So you have to go into a repayment, okay? All right, so why is it important to have a good mortgage partner? Obviously, we talked about a lot of information today. So it's important to partner with somebody that's got product knowledge, that knows what programs are out there to help your buyer, because not every buyer is going to have a plain vanilla loan or situation, right? You have to know what programs are out there and what products will help the right person. An FHA loan might not be the right loan for somebody that has large down payment, because even if you put down 50% on an FHA loan, you're still going to have mortgage insurance. So you don't want to put someone in that loan that doesn't need it. A VA loan isn't for everyone, right? It's only for veterans. So you're not going to give a non-veteran a VA loan. So that's obvious, but what I'm saying is you want to work with someone that has the experience and the knowledge of all the programs that are out there. Experience, I think that goes without saying. You want to work with somebody that's worked on purchase transactions. A purchase transaction is very different from a refinance. There's a lot of hand-holding involved. There's a lot of issues that go in that involve the property, like the condo project approval, knowing when you might get an appraisal waiver so that you can help draft your offer to be as competitive as possible. So all that stuff, the experience really comes into play, because you learn something new on every transaction and you build on that as you go throughout your career. And so it's important to work with somebody that's had experience. Communication, I mentioned it many times in the presentation about working as a team. So it's really important to work with the lender that communicates with you, lets you know what your buyer's strengths and weaknesses are, so that, again, you can portray that in your offer, and that you're not wasting your time showing properties that the buyer may not qualify for. And most importantly, it's to make the buyer feel that you work with a team, right? That me and you and the agent knows what's going on at all times, so that they're not feeling like they're having to talk to two different people and, find out the same information from two different people. The lender should be in communication with the agent, so that everybody's in tune with what's going on. Availability, obviously, we know that real estate happens on the weekends. And if you're not answering your phone and you're not available to answer questions about potential offers that you may be drafting up on a weekend, and you're not there to answer questions from the buyer when it can be kind of an anxious, stressful time, that goes a long way. So availability is really key. I also mentioned being locally focused. So again, I'm here local to your market. We're in Irvine here by the Spectrum. We're an affiliate with OCAR and have been for many years. And it's important to know what's going on in the marketplace, right? I mean, I work with a lot of the same agents, and when they see my pre-approval letter come across and I've worked with them before, that gives them a good feeling knowing that, you know, hey, I'm working with a competent lender and I've had, you know, good transactions with them in the past. That might make them more inclined to accept your offer. So the local focus, I think, is important. Execution, I think that goes without saying. I mean, if you can't get the deal done, you know, it's going to result in a bad experience for the buyer. And we're all, you know, we're all hoping for referrals, right? That's the easiest way to grow your business. And when you execute and you leave the buyer with a great experience and they feel like they can trust you, you know, when they go to sell their property and purchase the next one, they're going to call you, right? And so that's what we're striving for, is to have that overall amazing experience and leave the buyer with a great feeling, so that they, you know, leave you a good review and send you referrals, right? And then finally, you know, reputation, relationship. I think I kind of mentioned that, you know, you want to execute, leave the buyer with a great experience. And we're really relationship based. You know, we tend to work with the same agents, the people that we can trust our clients with. That, you know, when we have a pre-approved buyer and we need someone to show them property, we want to send them to somebody that we also know is doing a good job, because the referral is the ultimate goal. And we really strive to make sure that our buyers have a great experience. So hopefully you guys learned at least one or two things that you can take away from today. I really encourage you to jot down our contact information. This is part of our team that we have. We're across 6 different states, and we're affiliates with OCAR and would love to help you guys excel and grow your business. And if it's just to answer a question, that's what we're here for. That's why we provide free information, and just want to educate you guys and help you get better. So if there's not any other questions, thank you so much for joining. And as Elsie mentioned, we'll be giving the class again in September, but please feel free to reach out to me directly if there's anything that I can help with. All right, guys, thank you so much, and enjoy the rest of your week.